Travel Plus Leisure Co. delivered a clear beat on their Q2 2026 earnings this morning. They cleared consensus, and we're already seeing shares pushing higher in early trading on the back of this report.
Yeah, the market reaction makes total sense when you dig into the numbers.
Right, so let's hit those headline numbers first. Net revenue came in at $1.06 billion. That is, it's a 4% year-over-year increase. But the real story is playing out on the bottom line,
Oh, absolutely. The adjusted diluted EPS printed at a buck 88.
which is a massive 14% jump from the same quarter last year. And because of that bottom line performance, management went ahead and raised their full-year guidance across the board.
Yeah, they pushed their full-year adjusted EBITDA expectations up to a range of $1,065 million to $1,085 million.
So for anyone tuning in to track the leisure and travel space, this report is really a masterclass in how a mature company uses, aggressive capital allocation and portfolio optimization to drive earnings.
Right, because top-line revenue is only expanding in the mid-single digits, but they're still driving double-digit earnings growth.
Exactly. So today we are tearing into the mechanics of this earnings release to see exactly where this cash is coming from. We're looking at where they are actively cutting their losses and what their financial maneuvering tells us about the structural reality of the travel industry right now.
And honestly, the initial takeaway here is just the sheer scale of the cash flow relative to that revenue growth.
Yeah, 4% growth on $1.06 billion isn't exactly screaming hypergrowth.
No, I mean, typically you'd expect a pretty sleepy, stable earnings print with those numbers. But instead, they generated $109 million in net income. And their adjusted EBITDA, which strips out all that accounting noise to show the true operational cash, that reached $269 million.
Which is an 8% increase.
Right. Management basically took that operational outperformance and immediately turned it into an incredibly aggressive shareholder return program. That's really what gave them the runway to raise the full-year outlook.
Let's talk about that outlook for a second, because beyond the EBITDA bump, they also raised their expected gross VOI sales.
The vacation ownership interest sales, basically the core timeshare volume.
Right, the timeshares. Some people think timeshares are like a relic of the past, but they are projecting between $2.6 billion and $2.675 billion in sales for the year.
It's a billion-dollar growth engine. And CEO Michael Brown leaned heavily into this on the call. He cited exceptional execution on the sales floor and the integration of 2 recent acquisitions.
Yeah, those acquisitions just added over 100,000 new owners to their ecosystem.
Which is huge because management noted these were immediately accretive acquisitions. They aren't multi-year turnaround projects draining capital. They are actually adding to the earnings power from day one.
Okay, but even with those acquisitions, we have to look a little closer at the per-share math.
I agree, because it does get a little complicated.
Right, so we have top-line revenue up 4%. And adjusted EBITDA up 8%. But adjusted earnings per share jumped 14%.
Yeah, that EPS growth is outpacing revenue growth by, a factor of 3.5.
Exactly. And when you see that, it raises a red flag about financial engineering. You have to ask, are they actually selling that many more vacations? Or are they just shrinking the denominator to manufacture a better EPS?
Well, looking at the cash flow statement, they returned $125 million to shareholders this quarter.
Right. It's like a traveler who just got a massive unexpected bonus at work, and they're treating themselves by buying back their own stock and paying dividends at the same time.
Yeah, they paid out $37 million in dividends, but the heavy lifting was the $88 million spent buying back 1.2 million shares at an average price of $69.50.
So shrinking the denominator is absolutely driving a big chunk of that 14% EPS jump.
Oh, for sure. When you pull 1.2 million shares off the open market, the remaining shares naturally claim a larger piece of the earnings pie.
But is it fair to dismiss it as purely financial engineering?
No, I don't think so. You'd be missing the actual operational expansion happening underneath. CFO Eric Hoag gave some good context here. The first half of the year generated so much free cash flow that they could increase share repurchases by 25%.
While simultaneously reducing their leverage by approximately a quarter turn.
Right.
And just to clarify that leverage metric for anyone tracking the balance sheet, reducing leverage by a quarter turn means they pulled their total debt-to-EBITDA ratio down by 0.25x.
They are actively shrinking their debt footprint relative to their earnings power.
Which is wild. They're funding acquisitions, buying back a massive tranche of stock, paying a dividend, and paying down debt all at the same time.
You can only pull off that kind of capital allocation if the core business is throwing off just an immense amount of cash.
Right. So let's look at where that cash is actually coming from,
Hmm.
because travel plus leisure is effectively operating two contrasting business models under one roof.
Yeah, and the cash engine driving all this financial flexibility is definitely their physical real estate operation, the vacation ownership segment.
The core traditional timeshare business. And the numbers here show some serious margin expansion.
Yeah.
Revenue for this segment was $907 million, which is a 6% increase.
But the adjusted EBITDA for this specific segment jumped 13% to $247 million.
Right. Gross VOI sales hit $693 million, up 6%, and that was driven by 200,000 tours through their presentation rooms.
Which is interesting because 200,000 tours was only a 1% increase in actual foot traffic.
Right, so a 1% increase in foot traffic, but a 6% increase in sales volume.
And that disparity is the metric that matters most here. It shows up in their VPG, or volume per guest. That metric increased 2% to $3,318.
So for every single person who walks into a presentation, whether they buy a timeshare or not, the company is mathematically extracting $3,318 in sales.
It indicates an incredibly disciplined sales floor.
Yeah, they didn't hit their revenue targets by drastically increasing their marketing spend to shove, vastly more people into chairs.
Exactly. They just closed higher value sales with the qualified leads who were already in the room.
But the margin expansion, that 13% jump in adjusted EBITDA, that isn't just coming from selling more efficiently, right?
No, it's not. It's really coming from a massive structural reorganization of their real estate portfolio. Management is calling it the Resort Optimization Initiative.
Okay, break that down for us.
So they conducted a strategic review to align their property footprint with what their owners actually want to book right now, all while trying to preserve the affordability of maintenance fees across the network.
And the result of that initiative is pretty aggressive. They identified 17 different resorts that they are effectively abandoning.
Yeah, 17 properties.
These are properties that require, significant capital reinvestment or just sitting in markets where consumer demand has evaporated.
Right. And the financial mechanics of dumping these properties are fascinating because it requires taking a near-term hit for a long-term gain.
Yeah, it's like aggressively pruning a tree. You cut off the dead branches so the rest of the tree can thrive. But wait, I want to push back on the finances of that for a second.
Okay, go ahead.
They booked a $6 million charge this quarter, bringing the total to a $25 million write-down in the first half of the year, just in inventory impairments to cut these properties loose.
Yeah, a $25 million hit.
How does losing resorts and taking a multi-million-dollar accounting charge actually lead to a 13% jump in adjusted EBITDA?
I know, taking a $25 million impairment charge on the chin sounds like it would destroy profitability, but it actually exposes the hidden toxicity of the legacy timeshare model.
What do you mean?
Well, the liability hiding on the balance sheet isn't just the corporate debt, it's the developer obligations.
Ah, right. So a developer obligation is essentially the cost of unsold inventory.
Exactly. If you view a timeshare resort like a massive condominium complex, every unit requires year-round maintenance, roof repairs, pool cleaning, landscaping.
And those costs are divided up among the owners via their annual maintenance fees.
But for any weeks or units that Travel Plus Leisure hasn't sold, the company itself is on the hook for those maintenance fees.
Because they are the developer, so they have to eat the cost of the empty rooms.
Right. And that cash bleed is the silent killer in this industry. If a resort is in a market that peaked, say, in the late 90s, but sees very little foot traffic today, the company is just sitting on a mountain of unsold inventory.
Paying maintenance fees year after year on empty units.
Exactly. And as those physical buildings age, they require special assessments, massive one-time capital expenditures for structural repairs.
So if Travel Plus Leisure owns a large percentage of the unsold inventory in a dying resort, they are writing massive checks just to keep an empty building standing.
Which is why taking the $25 million accounting hit to dump these 17 resorts makes so much sense. It instantly plugs the hole in the boat. They just stop paying those ongoing developer obligations entirely.
Okay, so the expense savings they generate by eliminating those developer obligations actually outpaces the revenue they lose from no longer collecting property management fees at those 17 resorts.
Bingo. It fundamentally improves their operating margins. And honestly, it protects the consumer too.
How so?
Well, in a half-empty resort, the remaining retail owners often see their maintenance fees skyrocket to cover the operational gaps. By severing ties with dying markets, the company preserves the overall affordability of their network.
Which keeps their core owner base engaged and willing to upgrade.
Exacts.
It really is a masterclass in addition by subtraction. So the physical real estate business is booming and being ruthlessly optimized for profit.
It is. But remember, the vacation ownership segment is only half the story.
Right. The other side of travel plus leisure is their travel and membership segment. This is their digital platform, the travel clubs, and the proprietary exchange networks.
And the earnings data from this segment reveals a severe structural margin squeeze. It's basically the inverse of the physical resorts.
Yeah, travel and membership revenue actually decreased 5% year over year, down to $157 million.
And the adjusted EBITDA for the digital segment dropped 11%, landing at $49 million.
But here's the paradox buried in those numbers. Consumer activity is actually up.
Oh yeah, transaction volume increased by 6% across the segment. They hit 413,000 transactions.
So the activity is up, but the yield is collapsing. They facilitated 6% more transactions, but the revenue they generated per transaction dropped a painful 12%, down to just $263.
To figure out why the profitability is shrinking while the volume is growing, we have to split this digital segment into its two underlying products.
The traditional exchange network and the newer travel club.
Exactly. The exchange network is their legacy digital product. This is primarily their RCI network, where an owner pays a fee to trade their deeded week in Orlando for a week in Vegas.
And that specific exchange transaction revenue dropped 14% to $63 million, which is driven by a 13% decline in actual exchange transactions.
Right. Consumers are just using the traditional swap mechanism less frequently.
But then you look at the travel club side of the segment. This is where they sell subscriptions and facilitate broader, non-timeshare travel bookings, like hotels or rental cars.
And transaction revenue there actually rose 5% to $46 million.
But that 5% revenue bump required a massive 27% increase in transaction volume.
Yeah, they are booking significantly more trips for their members, but the revenue they extract per travel club transaction plummeted 17%, down to a mere $189.
It's like hosting a busy garage sale. You're selling way more items than you did last year, your transaction volume is up, but at the end of the day, your cash box is lighter because everyone only bought the 50-cent items and ignored the premium antiques.
That's a great analogy. It highlights a rapid shift in the quality of revenue. The traditional exchange transactions on the RCI network carry fantastic profit margins.
Because they operate a closed ecosystem, the fee to swap weeks drops straight to the bottom line.
Exactly. The travel club transactions, however, operate in a highly commoditized market.
Right. If you are facilitating a discount hotel booking for a club member, you're suddenly competing with every online travel agency on the internet.
And the inherent profit margin on booking a weekend hotel stay is just a fraction of the margin on charging a proprietary timeshare exchange fee.
So the volume shows that consumers clearly want this flexibility. They want the travel club model.
They do. But as you transition your user base from high-margin proprietary exchanges to lower-margin flexible bookings, you run into that exact garage sale dynamic.
A high volume of low-margin sales. They are facilitating more trips, but squeezing significantly less profit out of each one.
The modern consumer demands flexibility, but providing that flexibility strips away the pricing power the company historically enjoyed within its walled garden.
And this margin squeeze explains exactly why they are so hyper-focused on optimizing the physical real estate.
They have to be. They are relying heavily on the growing cash flow from their vacation ownership sales to subsidize the shrinking margins of this digital transition.
Right. Managing a booming, capital-intensive physical business alongside a shifting digital platform requires some serious financial maneuvering. Which brings us to how they're bulletproofing their balance sheet.
Yeah, management's maneuvers in Q2 show a clear effort to insulate the company against macroeconomic headwinds.
So let's look at the debt structuring this quarter. They issued $900 million in senior secured notes at a 6.25% interest rate.
And they took the proceeds from that issuance and immediately redeemed $650 million of secured notes that were scheduled to mature in July 2026.
And those older notes were carrying a higher 6.625% rate. So it's basically the corporate equivalent of strategically refinancing a mortgage right before a balloon payment is due.
Right, exactly. You swap an old higher rate for a new lower one. It clears the runway and pushes their major debt maturities further out.
It buys the management team time to execute their strategy without a liquidity crisis looming next year. But, we still have to look at the aggregate debt load.
We do.
They're carrying $3.7 billion in corporate debt. And that figure excludes another $2 billion in non-recourse securitized debt tied directly to their consumer loan portfolio.
Right, so nearly $6 billion in total leverage.
In the forward-looking statements of this very earnings report, management explicitly lists inflation, higher interest rates, and recessionary pressures as primary risks.
Which is standard, but definitely relevant here.
So if a recession hits, is this highly leveraged balance sheet going to become a trap?
It's a fair question, but the structure of the debt actually provides a significant buffer. That $2 billion in non-recourse securitized debt is ring-fenced.
Explain that for us.
Non-recourse basically means that if the consumers default on their timeshare loans, the creditors can repossess the timeshare collateral, but they cannot go after travel, plus leisure's broader corporate assets.
So the parent company is completely insulated from the consumer default risk.
Exactly. They originate the loans to the consumer buying the timeshare, package those loans up, and sell them off to Wall Street.
And the recent securitization deal they closed just after the quarter ended gives us a real-time look at how Wall Street is pricing that consumer risk.
Oh, it's fascinating. They packaged up a $300 million term securitization transaction and sold it into the market with a 5.52% weighted average coupon.
But the critical metric there isn't the coupon, it's the 98% advance rate.
Right. The advance rate is the most transparent indicator of institutional trust in a company's underwriting standards.
Because a 98% advance rate means Wall Street is effectively handing travel, plus leisure 98 cents on the dollar upfront in cash for this portfolio of consumer loans.
Exactly. If institutional buyers believed a recession was truly imminent, or that these customers were likely to default on their timeshare payments, that advance rate would be sitting at 80 or 85%.
The buyers would demand a massive cash cushion to absorb the anticipated loan losses.
But securing a 98% advance rate in this macroeconomic environment proves that the credit markets still fundamentally trust the quality of the consumer paper travel plus leisure is generating.
They look at the FICO scores of the owner base and believe those consumers will continue to prioritize their timeshare payments, even with inflation.
Right. And as for the $3.7 billion in corporate debt, the absolute dollar amount is high, sure, but it's entirely manageable against their cash flow.
Because they generated $258 million in net operating cash in just the first 6 months of the year.
Yes. Plus, they took a proactive loan loss provision of $141 million for the quarter.
So they are actively provisioning for defaults while still generating hundreds of millions in free cash flow and lowering their leverage ratio below 3.2x.
The balance sheet is built to absorb a shock.
So bringing all of these metrics together, it really paints a picture of a management team executing a very complex balancing act. Travel plus leisure delivered a highly profitable Q2 by leaning heavily into their core vacation ownership sales,
Extracting more revenue per guest.
and aggressively taking the accounting hits necessary to dump 17 deadweight resorts.
Right. They are using the cash flow from that optimized physical footprint to fund share buybacks, pay down debt, and offset the structural margin squeeze happening in their digital travel and membership segment.
It's an incredible look at how a legacy business operates today.
And, it leaves us with a really fascinating long-term dilemma for the entire leisure industry to mull over.
Makes that.
Well, management openly stated they abandoned those 17 resorts because they no longer align with owner demand. It really forces you to ask a broader question about the future of travel real estate.
Right.
As extreme weather events escalate, and as the younger demographic of travelers demands flexibility over stationary, repetitive vacations, what exactly does the modern consumer consider a desirable destination?
Oh, that's interesting, because how will that geographic migration reshape the entire real estate footprint over the next decade? The flagship properties that generated massive cash flow in the 90s are becoming expensive liabilities today.
Exactly.
The winners in this space won't just be the companies that can sell efficiently. It'll be the ones that can aggressively prune their portfolios and migrate their capital into the flexible markets the modern consumer actually wants.
If you're holding stock in the leisure sector, you really have to watch where they are abandoning properties just as closely as where they are building them.
Absolutely. Well, that wraps our analysis of the Travel Plus Leisure Q2 print. Make sure you are following the show for our daily earnings coverage as we continue to break down the quarter's biggest reports.